All right. So let's go up to the drawing board here for a moment. So in an uptrend, you have your basic uptrend, you have a basic downtrend. Let's do the same thing on the other side. So we went down, up, up, and then down again. All right. Now let's say that right here, you had a SFP and price came down as such and closed like that. The job of this low has failed because it was not able to close above this point here. However, if this expansion leg, which is from here to here, this is an expansion leg, this is an expansion leg, as is this, as is this, as is this. If the most recent expansion leg that caused the failure does not transition market structure on a lower time frame from an internal approach, then technically speaking, you cannot with confidence say that this has to work. Now, you're not always going to have this luxury because sometimes you may notice that the structure is something like this. No matter which time frame you go on, you may see a situation where you're like, well, dang, I got to wait for this to break just to confirm this? That doesn't even make sense. Sucks. I know. There's nothing we can do about that. There's nothing we can do about that besides use other form of TA, such as, volume, indicators, what other confirmations you see. Perhaps you're looking at the EXO data. You will have to think outside the box in a situation just like this. Okay, you will. Maybe it's where you pass on a trade. Maybe you don't want to take these trades. Or maybe volume is declining heavily while you're coming up to this level here, and that's enough for you to get involved within the trade. So for me, I would say it would have to depend on the situation. Like, is this a heavy resistance zone? Is it in the middle of no man's land? Is this a sketchier trade in general? Because if it is, I'm not going to risk it for the biscuit, so to speak. Whereas if this is in a heavy confluence zone, yeah, I might give it a whirl, but perhaps I may enter half my trade on, a portion of it on the break itself, or right up here rather. And if I get a transition of an actual trend here, I'll look for a retracement up and then add more of my trade, say right there. So you have to weigh these pros and cons, obviously, with every situation, because every single market structure situation that you find yourself in will be slightly unique. There never will be two things that are identical. It may appear that way, but generally it won't be. So in this case here, same thing applies in the opposite situation. So if you're in a downtrend and you have a move just like this, where price is not able to close below that low, but it wicks down quite aggressively, and you have a move just like this, where price actually closes back above, I need to see some kind of internal shift before I can verify that, hey, we actually are coming back for this pending high or this weak high. So in this case here, how do you do that? Go back to lesson number 2. That's how you do it. You have to look at any structure that exists between here and down here. So in this case, perhaps that structure looks a little something like this, where it came down, up, down, up, down. In this case here, perhaps you need to wait for this high to break before you can enter a trade. Now, maybe it broke on that SFP candle. Okay, so in this case, we could buy long and take it up towards that high if and only if it meets our risk to reward requirements. Because technically speaking, this would be the high that's targeted, not necessarily this guy or this guy. You cannot target more than you're allowed to target. You can leave some run in hopes that it works, but technically speaking, this is the overall order flow objective, and you have to keep this in mind. Okay? Now, obviously, if there's liquidity on the table, if there's a reason to go up higher, sure, yes, you can ride it up to 100K if you'd like to, but be realistic in your approach. All right, so let's actually go down and see if we can see how we would have entered this trade. And not only how we would have entered, but also why we would have gotten out of the trade. And if you look a little bit closely here on the 2-hour time frame, you had a double confirmation here using market structure. So using the weak low and weak high theory, technically speaking, not only was this level down here a weak targeted low because it SFP'd this high, but also on the 2-hour time frame, you also SFP'd this high. Therefore, this guy was a weak level as well. So you had double the reason to go lower here, which is excellent. That's what you want to see. When you have a situation like this coming into a high confluence area or a higher time frame market structure point, then generally that's when you're going to get these nice moves where you come down really aggressively. So in this case here, you had the transition in structure. You went from bullish to bearish from an internal standpoint. You can see what happened here. Price went down, we went up, price went down again, it went up again, and then it went down again. So ultimately, yes, you will have to follow that same structure pull. It's very vital that you do so, because if you're the guy that entered short right here on that official break of structure, and let's say you had to cover this on your stop loss to take it down to that low in question, this weak low way down here on the low, and I'll draw them out as a targeted level. We'll draw the little X marks spot for dramatic effect, and we'll go back up here. So if you're the guy that's short right here, and you've seen price come down and break structure in your favor again, then obviously you should have put your stop loss to here, covering the new high. And then price came down, price came up again. So where would your stop loss go after it broke structure bearishly once again? It would have went right here. So now the question remains, what do you do when you get stopped out? Do you chase it again? No. You get stopped out, you get stopped out. So in this case here, you would have been stopped out in this area. And from there, you could have switched your bias because this was no longer a weak targeted level. Let's draw it the same way that Bitcoin actually presented itself. The price came down as that lower high, you SFP'd the low, now you SFP'd the high. And this is what Bitcoin did on the 4-hour time frame last year on that low. So you had the X on the low, the X on the high. And when I say the X, I mean the swing failure pattern for reference. Okay, it makes it easier to say. So you had the X on the low, the X on the high, and now you have a targeted level because structure transitioned bearishly near that high. In fact, you had that double transition as we mentioned, so it looks like this. We'll use black. You had that bearish transition in structure, which justified the move as you were able to short it because of this, down towards the low. This is what you need every time, again, for that confirmation. However, what Bitcoin did is it came down a little bit, and then it was like, nah, that's enough for me. You know, I don't want to go any lower than this. I'm going to hit this order block perhaps in here, and we're going to go a little bit higher now. And this is what happened. We had that transition. You would have got stopped out of that short trade, which is fine. That happens. Because again, there's a bigger Wyckoff model at play, or if there's an order flow objective that doesn't agree with your weak low or weak high, liquidity overrules this every time. And we'll be, again, talking about that later on. So in this case, I would say that even if you didn't know this about liquidity, it wouldn't really matter because as long as you're following market structure, you would have been fine here. You would have got stopped out where you should have been stopped out. You could have let this thing ride and then let it take you out when it was ready. And then from there, once you've seen this transition, you can get involved with following it up perhaps, following it back up towards that high. This wouldn't necessarily be a weak targeted high, but in theory, you could ride it up towards that level. So what I'm getting at here is you will not always hit the full target of a weak level, but rather you may only hit a portion of that target, e.g. like a Fibonacci retracement level, e.g. a demand zone or supply zone, the 50% mark of the range, also known as the range equilibrium, an area of support resistance, all the same thing. Price doesn't necessarily have to hit the level, especially with these larger ranges. You have to keep that in mind. So obviously following your structure from an internal approach is vital because if you're not following your structure, you will not go very far with this.